Welcome to another Taking Stock episode for the week ending the 14th of August 2026. I'm Kien, Trinh, Head of Research at Stock Doctor, and joining me today is our equities analyst, Charlie Song, to stream to you all things share market. Welcome aboard, Charlie. We're in the middle of reporting season, so you must be under the pump.
Yeah, it's a bit busy right now, but it's great to be here, Ken.
Great to have you on board. But just before we begin, a reminder that today's discussion is general in nature and doesn't consider your personal situation or needs. But Charlie, we're in that middle of the reporting season. But first off, the RBA, they left interest rates unchanged at 4.35% this week, although Governor Michelle Bullock, she made it clear that another rate rise remains quite possible.
That's right, Ken. Inflation is clearly moderating in some parts of the economy, but the RBA does remain concerned about services inflation in particular, and the labor market remains pretty tight. At the same time, higher rates are clearly showing housing and consumer spending are slowing, and it's becoming increasingly relevant as we move through reporting season.
Yeah, especially those retail stocks. But one growth stock that you've been watching very closely, Charlie, is family location technology company Life360. Revenue did increase 31%, and their monthly active users, it passed 100 million for the first time, yet the shares were heavily sold down here.
Yeah, the main concern was profitability here. Third quarter EBITDA or cash operating margins guidance came in at around 18%, which was below expectations. And that was partly due to higher marketing and AI investment. The full year earnings guidance wasn't downgraded, but that requires a sharp improvement in fourth quarter margins. The stock also had a into the result, so there was little room for disappointment.
Yeah, definitely, Charlie. One of the stocks on our watch list this reporting season. But although it does look oversold, I think we'll be waiting just for that fourth quarter results to flow through before we think about adding any exposure here. But turning to the banks, quite interesting, the banks this week. We saw very different reactions across Commonwealth Bank, Westpac, and ANZ. But let's start with CBA and Westpac, where the housing slowdown is having an impact on their earnings.
Yeah, we saw Westpac reported mortgage applications down around 20% since the federal budget, while CBA's investor mortgage applications have also fallen sharply. Applications are a leading indicator of future loan growth, so this does point to weaker revenue growth ahead.
Yeah, certainly putting those banks under pressure. But the other issue here is competition as well. The banks are fighting harder for a smaller pool of mortgages and deposits, and that's putting pressure on net interest margins, the difference between what banks earn on loans and also pay for their funding.
Yeah, CBA's underlying result was still pretty strong in our opinion. Cash profits did increase 7% to $11 billion, and return on equity continues to improve and is now at 14%, the strongest of the major banks. Its premium valuation does mean that the market is less forgiving as the earnings outlook softens. Westpac faces similar housing pressures alongside high investment in its technology transformation.
Yeah, but in contrast, though, ANZ actually did pretty well with the share price rising on the result, and because I think it's less reliant on those mortgages with greater exposure to the institutional and also business banking, where lending grew by 7% and 4% respectively. Meanwhile, we had expenses which fell about 3%, margins improved, and also bad debts were quite low. And that's a great thing about ANZ. They've got that capacity to absorb more costs.
Yeah, and look, ANZ's done pretty well since their new CEO's come in, especially with its cost out program and continued integration of its Suncorp acquisition. That is providing greater scope to improve earnings over the short to medium term, and this does help explain the more positive reaction we saw to its result.
Yeah, definitely. And back to that technology sector, financial software provider Bravura Solutions, we saw revenue. They increased. Revenue actually increased by about 10%, but underlying profit, it rose significantly by over 100%. Now, that's continuing the significant improvement in their profitability we've seen over the past year.
Yeah, so they've done really well to turn around that business, haven't they, Kien?
Mm.
Importantly, FY27 cash operating guidance implies roughly 15% growth at the midpoint, ahead of consensus expectations. And Bravura also has more than $50 million of cash with no debt on the balance sheet, and they've recently announced a $15 million buyback in their shares.
So we expect these positive earnings revisions to continue, but the question now is whether it can transition from a cost-driven turnaround to more of a sustainable growth business. The recurring revenue and new client wins will become increasingly important as the benefits from this restructuring begin to moderate. Now, for Under the Microscope, this week we're looking at Australia's largest telcos provider, Telstra. Charlie, briefly take us through this business and where you think growth is coming from.
Yeah, so mobile is definitely Telstra's main earnings engine, and that's supported by around 15 million customers and its network advantage. It also operates fixed broadband, enterprise telecommunications, and infrastructure through InfraCo, its second biggest earnings engine. Recently, earnings growth have relied heavily on mobile price increases as well as cost reductions, while management is investing heavily in AI and network infrastructure to support longer term growth.
Yeah, quite an interesting business here, but the financial year 26 result that came in broadly in line with expectations. We saw profit increasing. The full year dividend, it rose by about 10.5% to 21 cents. And Telstra announced another $1 billion buyback, yet the shares were sold down. Charlie, what was the market concerned about here?
Yeah, mainly I was concerned about the quality and outlook for growth. Group revenue declined despite high earnings, so the improvement largely came from pricing and cost reductions. Mobile income also increased, but postpaid subscriber growth was relatively weak. So people are switching from postpaid to prepaid. And fixed and enterprise and international revenue continued to decline.
Yeah, quite interesting. And the financial year 27 guidance, though, it didn't really provide much upside either. The midpoint of underlying earnings guidance implies around about 4% growth, while capital expenditure is increasing. So where does the next leg of earnings growth come from here?
While mobile remains central to that leg of earnings growth, and Telstra needs to balance further price increases with subscriber growth. Longer term, its Aura project, which is a new intercity fiber network, provides another opportunity. We've already seen Google, Amazon, Microsoft, and Firmus Technologies sign on as foundation customers.
Yeah, this opportunity is increasingly tied to AI and data centers, which requires huge volumes of data to move quickly between those facilities. But does the increased investment put the dividend at risk?
We don't think so at this stage. The payout ratio at 82% remains manageable, cash generation is solid, and the higher capital expenditure was broadly expected. The 22-cent dividend in FY27 looks relatively sustainable, with ample free cash flow providing a buffer.
Yeah, and finally, Charlie, that recent nationwide network outage was clearly damaging, and management has done some changes. They've taken some accountability with CEO Vicky Brady. Her remuneration was reduced by around 600,000, and there was also wider executive bonuses which were cut as well.
Yeah, and an independent investigation is still underway. For investors, the key question is whether the outage reveals broader operational weaknesses. Reliability supports Telstra's premium positioning, so any systemic issue would be more concerning than the immediate financial cost.
Our question of the week this week ties directly into reporting season. So, Charlie, how do you tell whether a sell-off is a warning sign or potentially buying opportunity?
Yeah, let's start by comparing the share price reaction with the fundamentals. That's the most important part. A weaker result may lead analysts to cut future earnings forecasts, and we think that's justified. But if earnings expectations fall 5% and the share price falls 20%, that may be an opportunity if the long-term investment thesis remains intact.
Yeah, it's important to be objective here, isn't it, Charlie? And that's where you need to read beyond that headline. First of all, has financial health deteriorated? Is the debt rising or cash flows weakening? For an income stock, is the dividend at risk? For growth stock, are margins or return on invested capital or return on equity deteriorating because of its competitive advantage? Is that also weakening?
Yeah, and earnings quality we think matters too. We look at free cash flow and cash conversion. And the question we ask ourselves is earnings growth consistent with growth in operating cash flows? We're mindful that growth may be driven by one-off gains, acquisitions, or unsustainable cost reductions.
Yeah, that's right. And the important question here is also, is that issue temporary or structural? So you've got whether if it's a delayed contract and that could reverse as well, or losing customers, pricing power, or market share can permanently change those future earnings.
Yeah, and management credibility also matters. One miss typically can happen, and that might not be in their control, but repeated downgrades or overly optimistic guidance does raise questions about their visibility and their biases in their commentary.
Yeah, this is certainly an ongoing risk we're monitoring. So, an opportunity arises when the share price reaction is greater than the deterioration in those fundamentals and future earnings, but ensure the original investment thesis remains intact. That's all we have time for today, Charlie, but thanks again for your insights. It was a pleasure having you on board. I know how busy you are.
Thanks, Yen, and thank you everyone for joining us for this episode.
And with reporting season in full swing, remember to keep an eye on all your announcements with our alerts and updated commentary as well. Until next time, have a happy, healthy, and prosperous week ahead.